All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. All right, so today is Friday. It's March the 3rd. It is 10:07 a.m. So I just got into a trade on the call side. I put on a vertical call credit spread, and I got into the trade at 9:59. So essentially, let me pull up my pointer here. Let me just look at 9:59. Right. So essentially, I got in right here on this candlestick here. So I was watching it. Of course, I always like to be in front of my computer at the open. So I was watching the market pretty much pump. It opened up at 39.99 roughly. Yesterday's closing price was 39.80 around about. Let me just look at my spreadsheet here. Yeah, so if I pull over the spreadsheet, yeah, so yesterday's closing price was 39.81. So this morning it opened at 39.99, right? And I sort of expected a bounce, and it was pumping this morning. So I'm looking for the inflection point, the point in which the price is actually going to pivot. Okay, and so I also have my three resistance levels that I'm looking at. Sorry, guys. All right, so I have my three resistance levels that I'm looking at. So I'm looking at 40.15 as a potential resistance level, or I should say area, 40.25 and 40.33. Now, also, so yesterday's closing price was 39.81. Today's expected move is 33. So 2 times today's expected move is 66. So that's roughly, that's at 47. So adding 66 to yesterday's closing price gives you 2 times the expected move. So my position, and I'll show this later on in the video. So my position is at 40.55 and 40.65. So I'm well above the 2 times the expected move on the call side. So I feel pretty good about this position here. Again, if I pull it over, let me just see if I can pull it over right quick. All right, so pull in the no longer Tasty Works, and now it's called Tasty Trade. But see here, yeah, so it gets kind of funky when I pull it from one screen to another. But as you can see here, the position is at 40.55 and 40.65. I had to close this out and basically log back in order for this to be centered correctly. But yeah, so I am in a call credit spread. I've sold 4 contracts. Let me just move this back over here. And I'm pretty confident about the position, so one of the Fed guys is going to speak this morning. Let me just bring that up right quick and show you guys. So I always check the news just to make sure I'm aware of what's going to take place today. So this guy, let's see. Yeah, so this guy Logan from the Federal Reserve is going to be speaking today at 11 a.m. So definitely going to keep a watch out on that. And then Bowman is going to be speaking at 3 p.m. today. Another Fed guy. I don't know why these guys need to be talking throughout the weeks when they're not actually having an FOMC meeting, but nevertheless, they I guess they're required to make comments on the economy. So yeah, so I'm going to come back. Looks like the price is starting to go back up. But yeah, so I'm pretty far away from the current price of the underlying, which is underlying. Of course, we're looking at SPX, and then the current price is 4,001. So I'll come back and give you guys an update. All right, I'm back. So it is 1 minute after 11 o'clock, and I want to bring up the website. So here's a website that I use quite often. It's called stocklabs.com/news. And so, as I mentioned in the first video segment, that the Federal Reserve guy Logan will be speaking at 11 o'clock. So he just released his commentary, and so as you can see here, Fed's Logan says financial system vulnerable to market dysfunction. Yeah, so that came out 2 minutes ago, and the market doesn't seem to be reacting in any unusual way to that statement. So that's a good thing. But nevertheless, so it looks like my first resistance level of 40.15 is holding true to form. All right, let me pull out my pointer here. Pointer always X range. Okay. All right, let me change the color. All right. Yeah, so it looks like that 40.15 resistance area is holding true to form. So as you can see, there are, of course, it's not going to be right and exact. It's just the area around 40.15. So as you can see here, this candlestick actually got to 40.1872. So slightly above it, but nevertheless, this area here represents an area of resistance, at least the first area of resistance that I'm looking at. So it's holding true to form. And again, my position is at 40.55. At least the money strike, the short strike, is at 40.55. So yeah, definitely. That's definitely a high probability position to be in. Right? There are no certainties. We think of the market in terms of probabilities, not certainty. So could it get up to 40.55? Possibly, but it's highly improbable, right? There's a high probability that it will not reach 40.55. That's just based on the fact that the market very seldom moves past a 2 times expected move. All right, so as you can see now, it's starting to come down a bit. I'm actually thinking about going on the put side as well, but I'm going to wait until probably later this afternoon to decide whether or not I want to put on a put credit spread in addition to the call credit spread that I already have on at 40.55 and 40.65. All right, guys. Yeah, so 11:14 a.m. So I'm actually looking to put on a vertical. I'm looking to add to this vertical call credit spread by adding a vertical put credit spread, of course. Looking to sell to 39.60 and looking to buy to 39.50. High probability trade, right? So this dotted line here represents a 2 standard deviation move. Meaning that basically it's a high probability trade from a statistical perspective. Go to the activity tabs. As you can see, I'm looking to get 35 cents. I'm asking for 35 cents, and it looks like they're willing to pay 35 cents, but have not gotten filled yet. As you can see here, it's still working. Still working. But I like being at the 39.60 point for my short strike. Let me just pull back up. The 39.60 would put me roughly 39.60. 39.60. All right. Yeah, so it would put me in a good position for a high probability trade, right? So as you can see here, so one of my support levels or support areas that I have highlighted here on the chart is 39.73. That's my first support area. So if I'm able to get filled on that trade here of 39.60 and 39.50, and that'll put me in between my support levels on the downside, you know, so 39.73 and also 39.49. Again, it looks like you know, the 40.15 resistance area really holding through the form. As you can see here, it's broken through the actual 40.15 level. All right, guys, so I'm back. It's 11:39. As you can see here, I put on I added to the vertical call position by putting on a vertical put spread. So I've sold the 39.70 and I bought the 39.60. And again, this is a symmetrical, it's an iron condor. So basically when you sell a vertical call credit spread and also a vertical put credit spread, it's called an iron condor. And when both sides are symmetrical, they are the same, meaning that the width of the strikes is the same on each side and also the same number of contracts, then there's not any more buying power required to put on this additional vertical spread. And so you're just taking in additional credit without actually having to put up any more money, right? Because both sides are the same. So you can only be wrong on one side. All right, so yeah, here's a price of the underlying SPX, of course. Right now is at 40.14 and some change. The expected move is constantly contracting. Right, so earlier it was at 23, so now it's at 16. So we have most of the 11 sectors that make up the S&P 500 in the green. We know that the big daddy is XLK, which has about 27%, have a 27% impact on how the market moves. And so it's a little over 1%, which is good. It means that, you know, we're not going to see a major pump. So if you see this XLK sector above 3%, then, you know, normally you can expect a pretty significant move from SPX. If we look at the market internals, we can see that the advanced declining indicator is at 1465, right? And we can see that the volume is constantly increasing as well. So I think I don't think, you know, I think the market is probably going to finish around, you know, between 30 and 40 points up from yesterday's close. So yes, I don't think it's going to move much more than where it is currently. Again, I'm not sure, I don't know, but I suspect that it won't move much more from where it's at right now. And again, that's only because, you know, again, we got the Federal Reserve, the FOMC meeting on 22 March. So, you know, there's still some uncertainty that's in the market. I'm sure that most of your large institutions are really banking on the fact that the next interest rate hike will be 25 basis points. You know, a couple of the Fed guys said that they're looking to they would actually like to see a 50 basis point rate hike, but I think nevertheless, I think it's going to be 25. We're going to see two 25 basis points rate hikes for March 22nd and also May the 3rd. I forgot to mention the actual credit that I took in. So the credit that I took in for these positions is $240. So as you can see here, I made 41% of that. My delta is right where I like to see it. So it's right smack dab in the middle. It's close to zero. You're never going to see a delta of zero, of course. But that just means that the price of the underlying that just means that your vertical spreads on the call side and put side are even. In other words, are even with respect to where the price of the underlying is. So it's like being on a seesaw, and both people on each side of the seesaw are at the same level, if you will. So the price of the underlying is right smack in the middle of the spread on the put side, and also the spread on the call side, which is the reason why you see the delta basically at zero. And that's where you want to be. You want your delta to be as close to zero as possible, because it conveys that your position is neutral. All right. All right, so it's 12:05. The price of SPX has risen slightly, and that is reflected in the delta. So remember, before, the delta was actually roughly zero, but now it's at -7. So because the price of the underlying has risen slightly, then the delta becomes negative. So a negative delta essentially conveys that your P&L would actually benefit from the price actually decreasing, going down in value. So when your delta is negative, when your position's delta is negative, that means that that your position will benefit from the price of the underlying decreasing. Okay, now if this was a +7, then basically that means that your P&L or your position will benefit from the price actually increasing in value. But yeah, we got roughly 4 hours before the market closes. Price is at 40.23. I think on the last segment it was at 40.15, right? So that's when the delta was actually pretty much zero. So yeah, I have no concerns right now. The price, the positions are looking good. Certainly have no concern about the vertical put spread, and really don't have any concern about the vertical call spread either. So we'll see. I'll come back maybe an hour or two from now. All right, so I'm back. It's 1:11, 11 minutes after 1. So as you can see here, the price of SPX has broken through the three resistance areas, the levels that I have marked off on this 1 minute chart here. Let me just go to 5 minutes. Yeah, so the current price of the underlying, we're at 40.34. Right, so market is having a nice pump today. Looking at the actual position itself, so as you can see here, here's the price of the underlying at 40.34. My short strike, my money strike is at 40.55. Somewhat close, but I'm going to let it ride out. My P&L right now is at negative, right? -20. And as you can see, the delta is negative as well. Again, because the delta is negative because the position actually will benefit from the price of the underlying going down in price. So that's what the negative is telling me, that it has to come down in price in order for my P&L to actually to benefit. So because of the proximity of the price of the underlying to my short strike on the call side, the position's value has actually increased. So as option sellers, we actually want to get into a position and then have the value of the position actually decrease, so that if we decide to get out of to close out the position, we can close it out by buying it back. Since we have sold it, in order to close it out, we buy it back, and hopefully we can buy it back for less than what we sold it for, so we can walk away with a credit. But yeah, so I'm gonna let I'm not going to jump out of this position here. I'm gonna let it ride. And as we can see here, the expected move has contracted even more. So now it's at 12. Right, so it's at 12 now. Looks like it's going to 11. So yeah, so I'll come back and let you guys see. All right, I'm back. It is 2:35 roughly. As you can see here, the price of SPX is 40.41. It actually is a lot higher than I expected. I expected it to go no higher than maybe 30 to 35 points, but as you can see here, it's close to 60 point. It's close to a 60 point move when it, well, there you go, 60 points. So as you can see here, the price is rather close to my short strike on the call side of 40.55. I'm actually considering putting on another vertical put spread, doing a $5 wide this time. So I haven't, I'm just considering it. I haven't tried to send the order yet. I haven't sent the order yet. I'm not sure I'm going to. I'm looking at the position here. So the position is down. It's down $20, right? So down negative. I'm down. I'm sorry. I'm down 13%. So it's down, constantly fluctuating. So we got the XLK at roughly a little less than 2% on a day, up 2% on a day, and XLV, which are the two largest sectors that make up the S&P 500 that have the largest influence. So the XLV is not, it's up less than 1%. So yeah, so I'm looking at the, I'm also looking at the E-mini as well. So the E-mini is oftentimes 4 to 5 points in front of the price of the SPX, right? So the E-mini right now is at 40.44, whereas the SPX is at 40.40. So as long as that E-mini stays below 40.50 or 40.55, I'm pretty good. And I'm willing to take a small loss here, so again, the theta value is constantly decreasing. So, even as we get closer to 4 o'clock, closer to market, the theta value is going to increase, and so meaning that there's going to be more value being contracted or lost from the position. And so it just means that even if the price of the underlying should, breach my short strike on the call side, the P&L won't be in a negative that badly, if that makes sense, right? Because it's going to be so little time left. But again, I still feel pretty confident about my position, my short strike on the 40 at the 40.55 strike actually expiring out of the money. So I'm going to come back maybe roughly 3:45. Again, I'm going to stay in the position. If I lose, I'll let you guys see the loss. I don't have any problem with that. But yes, I'll come back in 1 hour from now, roughly 1 hour from now, and let you guys see how the position is working out. All right, I'm back. It is approximately 3:49, so we got a little more than 10 minutes before the market closes. And as you can see, I am in good standings. So the position is actually going to expire out of the money on the call side, and of course on the put side, it's no question it's going to expire out of the money. So the market has increased today close to 60 points. Again, I was surprised by that. As we can see here, the And I think I misspoke. I think I said, I mentioned that the theta value will increase. No, the theta value actually decreases because the theta value corresponds to time. So as you approach the expiration date, theta value begins to contract and it loses value. And essentially that's what you want your position to do as an option seller. As an options buyer, the theta value becomes your enemy. But as an option seller, theta is your ally. So as you can see here, I pretty much made the entire credit of 240 bucks. As I mentioned, I thought about putting a position, a $5 wide credit spread on the put side, just because of the closeness of the price of the underlying to my short strike on the call side. But I rarely do that because, oftentimes, within the last 30 minutes or 15 minutes, oftentimes, because of the expansion of gamma, the SPX can move rather drastically in the last 30 to 15 minutes, So this side doesn't, it's not worth it. I'm just gonna, ride it out. I'm expecting for the SPX to pull back because it was over. Let's see here. It's not. Let me pull up my other screen. It was it was oversold for quite a bit some time. At around 2:45 again, around 3 o'clock, and so I was kind of expecting a pullback. And I was also looking at the E-mini, and the E-mini never got above 40.50. So although it was rather close, the price got rather close to my 40, 50, 55 strike price. I was pretty confident that it would probably pull back or just not reach my short strike of 40.55. Okay, so now it's 3:52, so 8 minutes before the market closes. So I think it's pretty safe to say at this point that I'll be walking away with the entire credit of $240.